A very good morning. It's Friday and it's the last day of a rather exciting, or rather not so exciting week, but record highs on the index. Global markets are looking excited this morning. Recessionary fears for the US, at least for now, or at least for today, are behind us. But there's a typhoon in Japan, which is not such good news.
Yeah, absolutely. And for Indian markets, I mean, the kind of surprise we saw in the last 20 minutes of trade yesterday is just astonishing. We have a whole seesaw of movement just in the last 20 minutes. And two stocks stand out. Tata Motors, one of them definitely, and the Bajaj Fin twins as well. But it's just been sort of a very volatile kind of a week. Are we going to top it off with a more positive sentiment is what we're going to see. Remember, at the end of it, we ended up with record highs at close as well because of the strength coming in. But let's get to the global piece first and get you a perspective of what's happening. Samina alluded to good US GDP data, and that's definitely one positive for markets. Not so much in regular trade in US markets. You had a mixed kind of a day. Of course, the Dow closing in the positive and at record highs at 41335. Nasdaq pulled down a tad, and profit booking in Nvidia, continuing as a theme. What the street is going to watch out for more than anything else is inflation data, retail inflation data, which will come out for the month later today. And that is what everyone's eye is on. So a slew of expectations which are out for the month of August, and we'll just take you through that. The expectation is that you will see a 0.2% monthly increase in July CPI. The annual headline inflation is expected to increase 2.5%. Now remember, this set of data comes after Fed Chief Powell's very positive comments at Jackson Hole, saying that we'll see the data, but we're set for September. So do you really continue in that momentum is what this data is going to tell us. So core inflation expected to rise 0.2% month on month and 2.7% year on year. Bond yields also have risen ahead of this PCE data, 10-year at about 3.86%. But I think the revisions for Q2 GDP was a positive surprise for the US and has put at bay some of those recessionary fears we were talking about. And we'll just go back to the US GDP data if we can. It's come in for Q2 at 3% versus what was clocked at 2.8% earlier. And that really is the big thumbs up. Even jobless numbers have been revised downwards. So those two are positives. But apart from that, let's talk a bit about crude. Crude has seen a rebound. The impact of disruptions of production in Libya, compounded with now a halt in production in Iraq, has seen Brent now nearing the $80 levels. Asia, meanwhile, has opened in the green after that positive US GDP revision. And let's just pull up what Asia is looking like. So right now, at least, Asia all in the green. Anurag Singh joining us now. He's managing partner at Ansett Capital. Anurag, very good morning to you, at least from where we're sitting. And great to speak with you today. Just let's start with your take on the revisions we've seen to US GDP and jobless numbers and what they're telling us about the recessionary fears which came into place after negative labor market data last month.
Yeah. Tamanna, good morning, and good to see you in a while, although on a different channel. But, we have grown up with NDTV, since, when I was in India, and so always respect this channel, so yeah, good to see you here, and it's a privilege being on this channel always. Now, having said this, Tamanna, I think there has been a lot of discussion around the job revision, and one, I would just reiterate what Goldman Sachs estimate is that probably it undercounted the number of not the kind of the legal workforce which doesn't have the employment insurance. So that's the kind of the 500,000 number which was overstated in one data and understated in the revised numbers when the employment insurance numbers came out. That seems to be the most plausible explanation. However, that said, I think the good numbers to track here, and look, there can be a variation always in the employment data, but I think the labor force participation number has inched up, but is kind of reached its peak, which is 62.7. That's pretty much the peak that we can achieve. on the labor force participation. And unemployment is at 4.3, which is not because workers have been fired largely, but because more workers have joined the workforce. So I would just focus on these two numbers. And they indicate a healthy story that there are more people joining the workforce, although that has peaked out. But at the same time, the existing jobs are holding well, which augurs very well for the economy. And we saw this in the GDP data also today, is that economy is in no way in fear of any recession or any such fear. At least that is what appears as of now.
Anurag, hi, it's also Samina joining in. I'm just trying to play devil's advocate here because I did come across an article by Gary Evans where he said that unemployment is still a problem in the US. You know, your unemployment data came in at 4.3% for the month of July. That is at a record high since October 2021. They even go on to say that 3 rate cuts are not going to prevent a recession that is coming. Because historically what we've seen is you get rate cuts from the US, Fed, and it takes about 10 months to actually see that impact the real economy. Do you feel like those fears are overrated at this stage? Because the markets are making us believe something completely different right now.
Yeah. So Veena, let's look at the past 3 years. And time and again, there have been two camps. One which strongly believed that recession is almost imminent, which propound the theory of the inverted yield curve all the time. But at the same time, we have to acknowledge that the central banks have become very interventionist of late, for the last 10, 15 years. And every time a bank fails or there is a credit crunch, they come out with a bout of liquidity support. And I think that is where the complexity lies. So so-called inverted yield curve, the predictor of inflation, hasn't really worked out. And I think even the so-called fears, even from some of the central bankers, in terms of their projection of the unemployment rate, that also has been all over the place, right? So, the dot plots are with us. We can look at the history for the last 3 years. Now, I think, look, there will always be a section of people who can continue to say that it is imminent. Well, who are we to say that there will not be any recession? But here is the crux of the story. As long as the jobs are holding up, then the recession is very unlikely. And let's examine what you said with a little bit of a history. I won't dwell into too much details, but I think if you go before 2019, I think that's where for the last 2017 to 19 is when the unemployment touched 3.5. Otherwise, 4%, 4.5% is a normal number. I would say even if it goes to 5%, that's a full employment level. So that's my sense, and a larger section of the market now believes that the kind of recession fears are behind us. By the way, all said and done, if something happens, we are in a rate cut cycle now. So there is always this Fed put, which can now come into play because it is, the inflation is more or less in control. Samina. So that's my quick take on this.
Anurag, just want to get a sense of what is the outlook on emerging markets and India. Post-September, with a rate cut coming in all likelihood, are we going to see more global funds coming back to India?
Yeah. So Tamanna, this is, I can do a 1-hour discussion on this subject. And
a minute will suffice, Anurag.
Yeah. So I was, my answer would have been, how much time do you have? Look, here is the story. I understand the momentum and the feel in India is very different, as if there's no stopping this party. But I think the rest of the world still sees India, it has a growth story going for it for a decade or two. There is no doubt about it. But it's also not as, bright. So, let me put a number to it. The nominal GDP will grow at 10%. Give or take 5% inflation, the growth would be 5 or 6%. I think the markets have run a bit too far ahead looking at those parameters. So I think that reality check or time correction has to happen. I understand some bit of regardless where the money is to be made, investors will come in. So if the 10-year yield is already at 3.8% in US, if it hovers in this range, 3.5 to 3.8, the money flow will come to India. Now people are talking about India, it's under discussion. The only point is there are certain more attractive pockets. So momentarily the money might find value there. All said and done, by the way, Indian market, somebody has to sell, right? If everybody is buying, then, there will be no ceiling to the market. So, by God's grace, there's somebody selling. For the time being, they are FIIs. And who knows, maybe somebody else sells tomorrow and then FIIs would be a buyer. But not at these prices. I don't think anybody is tempted to enter now. People are regretting they missed the rally, but, well, it is what it is.
You're right. Anurag, very quickly, a quick word. It's very rare that you get risk on and risk off assets moving in the same direction. Equities and gold. Where do you think gold and crude is heading from here? Because crude as well has had a whipsaw in the last few months.
So I think let the US elections settle and we'll know what is the trajectory on oil. Right, I'm very sure US is kind of keeping a closed eye on all the oil which is flowing from Iran or Venezuela or any such places, because that's a bit of they want to keep the oil little capped there. So that's my limited take there, and I don't understand geopolitics good enough to kind of comment beyond this. But that's one take. Gold, Suveen, there is a very interesting story going on. Ever since the US put sanctions and froze about 300 billion of Russian assets, central banks in emerging markets have got a signal that, look, it can happen to any country tomorrow. So they have been hoarding gold and buying gold. So the biggest buyers of gold in the last, couple of years have been Central Bank of China, Reserve Bank of India, Brazil, Argentina, you name it, right? It's a kind of a planned strategy. So, regardless of the consumer buying, central banks have decided that they're going to keep a percentage of gold in their, lockers. So I think that's something which is bullish for gold for the entire decade. It looks like that, So that's where, the risk off is, right? And, so it seems to be like everything rally. Take what you want.
It's all good news for now, but we'll wait and watch, of course. Anurag, pleasure speaking with you and hope to chat with you again on NDTV Profit sometime soon.
Always.
Yeah.
Thank you.
All right, Anurag Singh there, managing partner of Ansit Capital, saying perhaps it's not such a bad thing that FIIs aren't coming in and buying, but you'll be surprised when you see the data for the whole of last month. Let's pull up what happened yesterday. And remember, we saw this sharp swing up in the markets yesterday, very near closing, possibly FIIs coming in late trade, 3,260 crores of buys. Some of the highest we've seen this month, while domestic investors were also buying at 2,691. Let me pull up the figures for the month of August so far. And even though we've been seeing outflow figures pretty much every day, they have been squared off in a sense, because the net FII outflow for the month is only about 1,093 crores. Now compare that to the DI inflow and you see how significant it becomes, because 51,476 crore rupees of DII inflows. And, you might see that positivity come out. I don't know, some of the things to watch out for today, Samina, and of course you look at the setup, Tata Motors, what happens there. RIL, I thought after the initial spike on the 1:1 bonus, the fact that there was no mention of the IPO on retail as well as Jio might be seen in short term as a bit of a negative, because that's something that the street was expecting.
But the brokerages have upgraded the stock. So you've had a 10 to 20% upgrade on target price on Reliance Industries. What is worth a mention is, while you had this much anticipated AGM, RIL has been not providing its much needed support or leadership to the index. A whole bunch of heavyweights have, on rotational basis, contributed to the Nifty moving higher. RIL hasn't done so. It did add about 1.5% in trade yesterday, which might have helped the index to record new highs, but it came in with the support of a few more names on the heavyweights. Just a quick recap. Yesterday's day of trade was exactly the opposite of what happened on Wednesday. On Wednesday, it was the last half an hour when the market sold off, and yesterday it was the last half an hour that helped the markets record a new high on closing basis on the Nifty. Comfortably about 25,100 is what we had. 11 straight days of gains. The Nifty is up 4.2% in those 11 days and up 3% in the August series. We also wrapped up the August series yesterday on a high, and that's a good sort of sign for the bulls in trade. Broader markets have been underperforming. They continue to underperform in trade yesterday. Like we said, it was Reliance Industries, Tata Motors and the Bajaj twins that contributed to yesterday's up move. Going into trade today, experts bet that for the September series, 25,500 could be a possibility, but the immediate near term is going to be 25,300. 25,000 remains a very important level of support for the benchmark, and between now and the 18th of September, it's going to be interesting to see that the markets may hit those new records. While triggers might be missing, the big event, which is a Fed rate cut, may ensure that the buying momentum remains in the market for the next 18 to 20 days. Well, apart from that, it's Bank Nifty that is worrying me just a tad bit. All through August, Bank Nifty didn't do much. While the Nifty was up 3% for the August series, Bank Nifty has actually gone home flat as it gets. A number of failed attempts to gain, but it seems like the private sector banks have just no reason or trigger to let them up. Yesterday as well, during midday trade, the buying did come in on Bank Nifty, but it wasn't sustainable towards close. What also stood out is while you had stock-specific gains coming in, there was no major sector in trade that led the gains. So there was no leadership sectorally in that sense in the markets. Today, of course, with crude higher, oil and gas stocks may see some profit taking. Metals also will be back on the radar. It's expected to be a gap up, but that's largely on back of what's happening globally in trade. So consolidation with a positive bias is what we are working towards in early minutes of trade. So that's what we have, Tamanna. No runaway gains, and I think the runaway gains won't happen because you also have crude that's higher. So oil and gas stocks, paint companies, auto ancillary, anywhere where crude is an input, will see a subdued morning in the session. Yeah. Apart from that, Nvidia sold off, so no major IT triggers as well coming in from Wall Street. It's going to be domestic cues, a little bit of a handover from Wall Street, but consolidation, once again, I guess the 12th day of consolidation on the street.
But, having said that, I would say look at what the Nifty IT has been doing, and even yesterday, which is why the first stock on my radar is an IT stock. The Nifty IT, even through the week, and we'll get, of course, the weekly data end of the day, has been the outlier and the positive surprise. Even without the Nvidia backing, up about 2.5%, nearly 3% this week so far. So Infosys, let's talk a bit about Infosys. We've seen that run up in HCL Tech yesterday, LTI Mindtree the day before, Wipro to some extent, and Infosys is one that we should watch out for today. The news trigger is that they have announced the expansion of their collaboration with NVIDIA for AI-powered customer-centric solutions. They will drive innovation and operational excellence for telcos. This will leverage Infosys Topaz, which is their own product, with AI-powered technologies. This is specifically for telecom companies. Now, NVIDIA and Infosys already have a tie-up. They are expanding it. The revenue aspect of it is still to be determined because they need those kind of deals to come in as well. But remember, right now, for Indian IT at least, it is muscling up on the AI part of the picture, which Infosys, of course, seems to be doing. Great Eastern Shipping is the other one. Remember, defense stocks have been having a sort of a mixed kind of a response last couple of months. Great Eastern Shipping was down yesterday mildly, but now they've been contracted to sell a bulk carrier, a Supramax dry bulk carrier called Jagrani, which they made in 2011. So they're going to sell this to an unaffiliated third party. The vessels will be delivered to the new buyers by Q3. So is that when we see the revenue coming in is what remains to be seen. Their current fleet is of 43 vessels, which include 14 dry bulk carriers. So that's going to be sort of a positive for GE Shipping definitely today. SpiceJet, on the other hand, I mean, the news flow has just been so negative. The stock was up yesterday because of a QIP, nearly 7%, 6.5% up. But look at fundamentally what's happening. And in a note to exchanges, the company yesterday has said that they've temporarily placed 150 cabin crew members on 3-month furlough. Basically, they don't have to pay their salaries. They're benched for 3 months. They say it's because of the lean travel season and reduced fleet size. The cabin crew on furlough will retain employee status with all benefits, though. The airline is working towards enhancing their fleet following the upcoming QIP, and that's where perhaps a stock bump up is happening. The airline is looking forward to having crew members back to active duty. But just on SpiceJet, and we'll have a more detailed report later, we reported yesterday, NDTV Profit reported yesterday, that passengers in Dubai carrying SpiceJet tickets were not allowed to board their flights because there were pending payments from SpiceJet to the Dubai airport authorities. That was eventually resolved. But having said that, a few red flags there, and with airlines, especially in India, Samina, seeing what we have seen over several years and several airlines, these are some red flags which make it a little difficult. Additionally, they have been placed under DGCA surveillance as well.
Yeah, I think the only hope for the airline will be the QIP that they've talked about, and that was one reason why the stock actually was up ahead of that news flow that came in. But the hope is that there should be a fundraise underway for SpiceJet that could hopefully and potentially fix the house for them. The stock was up, but today it could be a tough morning for SpiceJet. Along with those, the first one on my list is keeping the focus on fundraising would be Prestige Estate. This one has been quite the favorite if you're a real estate investor. Prestige Estate has also early this morning announced about a fundraising plan, and a rather aggressive one at this. Prestige is looking to raise 5,000 crores through a QIP, and the funds will be used in order to expand and pick up more projects. The stock went home flat, but if this QIP goes through, it will spruce up the balance sheet and help Prestige with its aggressive expansion plans. Along with that, a quick word on RVNL. This one usually reacts to news flows where they've signed deals. RVNL has signed an MOU with Patel Engineering for hydro and other infrastructure projects in India and overseas. Also, as always, Nuvama estimates have come out with what the inflows would be in the stocks that get added to the MSCI index. RVNL is going to be added to the MSCI index, and the passive flows on this one could be rather significant. So you want to watch out for RVNL. It could be a mover in today's day of trade. Nuvama is estimating Rail Vikas Nigam could be a beneficiary of $212 million over the course of the next few years, the next few months, and of course, this is passive flows. Also, Prestige Estates, which I mentioned on the QIP, also has gotten added to the MSCI India index, and they could benefit from about $178 million of passive flows coming in. So those are the two stocks on my list. Apart from that, sugar stocks, you're going to have to watch out for this one. This one every now and then gets impacted by policy changes, but this time around, it's good news coming in for sugar players. The union government has removed the cap on sugar diversion for ethanol production. Sugar companies, remember, can produce ethanol from sugarcane juice, sugar syrup, B-heavy molasses, as well as C-heavy molasses, as per the agreement with the oil marketing companies. Analysts believe that the impact of this on sugar companies may take some time to show up, but on the face of it, this is positive news flow. These stocks as a block will be reacting and moving higher in today's day of trade. We will connect with Sri Lanka Sugars shortly over the course of the show to understand and quantify the impact of this policy change. Well, that's what we have on sugar, but apart from that, a few more names, Tamanna.
Yeah, no, we'll go into some of those details in a bit, but this is largely, what we have been seeing, and I think the big one to watch out for in terms of data is our own Q1 FY25 GDP data, which will be out later today. Expectations are that growth may be moderate in Q1, and these are some of the factors which will weigh on growth. Urban trends could be some of them as well. To discuss more on them, I'm joined now by Dheeraj Nim, an economist and FX strategist at ANZ Research, who's joining us now. Dheeraj, a very good morning to you and great to have you on the show. What is really the outlook for India coming after a day when the FY24 numbers have been upgraded by global agencies?
Well, look, thank you for having me on the show. As far as the Q1 FY25 is concerned, my forecast is below consensus. I think growth could slip to about 6.4% year on year. As far as the whole year is concerned, I haven't really changed my 6.8% forecast, which is also slightly below the Reserve Bank of India's, and I would say the market forecast as well. Now, in terms of the factors that I'm keenly watching, and of course, we all know that there was a bit of a government spending slowdown because of the national elections, which likely weighed on growth, perhaps a transient element. But we also need to see what's happening on the external sector. We could talk more about it, and what's happening to the investments apart from what's happening to the public capex.
Rich, a couple of triggers or cues that we've picked up on. Results of listed companies are very evidently showing a slowdown in profit growth. Rural demand, while is showing green shoots, the pickup is at a very early stage, and there's lower capex by the centre and the state government in the first quarter of FY25. Do you feel like all of this is concerning at this stage?
Look, I think we're in a bit of a transition stage, so to speak. We know that the government is consolidating the fiscal balances, and from the budget, we know that, all that extra fiscal bonanza, they've used to spruce up spending as well as consolidate the fiscal deficit. So, of course, if your fiscal deficit is going down so sharply, it cannot be strongly positive for growth, but we are thankful at least the capex budgets were not altered, and that could continue to support growth, especially, this year and of course, over the medium term from a potential growth perspective. But as you speak of rural demand, I think these numbers will still not reflect the kind of recovery we are expecting in FY25 as far as rural demand is concerned. Look, overall monsoon has been good, and if you're tracking the Kharif sowing trends, they have been looking encouraging as well, about 2 to 3% up over the year, especially for crops like pulses and paddy, which I think should mean better realizations for the people involved in agriculture, and of course should mean better for rural demand. But I think that should only flow into the data from this quarter and next. So obviously we'll have to wait to see the impact of those numbers. Now, coming to rural demand, I think there are several factors to keep in mind as far as private consumption urban demand is concerned. The first is, of course, that, there has been a bit of normalization from the post-pandemic surge or the post-pandemic pent-up demand surge, and that is still kind of playing out. But at the same time, we should be mindful that, a lot of the households are probably focused on building assets. We see the growth in housing loans, the real estate prices and everything. And therefore, with limited income growth, there's only so much scope for consumption growth to happen, if the households are building assets and their balance sheets are looking leveraged as well. So I think that urban consumption growth might at best remain modest. I think that most of the incremental growth will come from rural demand. But even so, I don't think private consumption will become a strong growth driver in FY25.
One quick word, because you do track the currency markets and the bond markets quite closely. It's completely priced in that the Fed will give us a rate cut as early. I'm saying us as if I'm American, but it's pretty much a rate cut for the rest of the world as well, as early as 18th September. What would that do to rate differential and do to our local paper? And also, more importantly, the dollar index has been declining all through August. Could that mean anything for the rupee? I do understand that the rupee is a relatively controlled currency, but nevertheless, could it mean good news on the dollar rupee pair? Could we be heading to higher levels anytime soon?
So as far as the rate differentials are concerned, look, we're still pricing in a much deeper rate cutting cycle in the US than in India. If the Reserve Bank of India gets to cutting rates, which we expect will happen starting December, it may at best deliver 3 rate cuts at 25 basis points each versus a much deeper rate cutting cycle we are expecting in the US. So of course, rate differentials are possibly going to turn in favor of the emerging markets generally, in India specifically. What should that mean for the bond market in India? Look, there was anyways a constructive demand-supply backdrop for the Indian bond market, the Indian government bond market, and onshore demand as well as foreign demand for IGBs is going to be strong in FY25 is our base case. So I think the fact that the market is now convinced that the Fed would be delivering rate cuts and it would be a good cycle of rate cuts, I think it bodes well from an external headwind perspective. But at the same time, after today, yesterday's GDP, the market would also have some idea of what the Reserve Bank of India might do. And I think that as Reserve Bank of India goes into a rate cutting mode or rate calibration mode, let me put it that way, it could also mean, further gains for the bond prices. Now, coming to the rupee, look, the dollar has slipped by about 2.6, 2.7% month to date, if I'm not wrong, and the broader Asian currencies have rallied more by about 3.3%. The rupee has gone the other way. It's depreciated by about 0.3%. And I think it is not surprising. It sort of extends or reinforces the tendency of the rupee we have seen that if there's any sanguine development from an external headwind perspective, especially from dollar weakness, the rupee has mostly dodged that. And the reason could be the Reserve Bank of India is very much present in the market, buying on the dips, and therefore, building up the FX reserves. And since a lot of this, is being expressed via financial flows, the Reserve Bank of India is wary that should not appreciate the rupee and make it uncompetitive. Mind you, the real effective exchange rate for the rupee is still about 107, very much in the overvalued territory.
Very lastly, quick question. India's inclusion on the bond index. Have you seen a pickup in flows recently, or it's largely status quo? We don't talk about it anymore as often.
No, I think it's as good as given, but much of that inflow has yet to occur. The estimates were anywhere in the range of $28 to $40 billion. That's a wide range, but I think even if you're looking at $28 billion, which is the lower end of the estimates, I think about $10 to $11 billion of that inflow is yet to occur, and that will continue to happen because this is a phased inclusion. So yes, I think bond inflows will continue to happen, which should continue to guide the Reserve Bank of India's FX policy and liquidity policy as well.
All right. Thank you so much, Dheeraj, for speaking with us. So, of course, we'll be keeping a track on that data coming out today. But let's just go across to Agam and get the F&O set up for the day. Agam, it was an exciting day yesterday, at least on close, and because of expiry. What's expected today?
Oh, well, it certainly was. And, as we move into the next week, we don't have too many big triggers lined up, of course. And I'm talking about the known unknowns at the moment. We don't have too much there. And that's possibly the reason why we're expecting a little bit of consolidation moving into the next few days as well. Now, yesterday was a day of trade where we saw the Nifty climb to a certain extent. It was propped up by Reliance Industries after it announced its bonus issue, and it's a heavy weight, so naturally you will have that impact coming through. And the Bank Nifty again actually did do whatever it could to support the Nifty move up higher. The index itself wasn't it did underperform the Nifty 50, but there were a handful of banks in the banking index which actually helped the Nifty upward as well. Now, moving on to the option markets this upcoming week, the most amount of accumulation is still at the 25,000 put, and that actually gives you an idea about what traders want to do. It does seem like in the near term it's going to be hard for the Nifty to close below 25,000 because it's been maintaining itself above that mark for a good 5 to 6 sessions now. And of course, on the higher end, we're going to have to wait and watch because it's still early days even for this particular weekly options expiry. Moving on, as far as stocks are concerned, a lot of shorts in Balrampur Chini, Interglobe Aviation, Aarti Industries, and among stocks which are seeing unwinding. Again, early days, but not too much going in here. Wipro, Apollo Tyres, and UBL perhaps are the others which are in focus today. But on that note, let's get in an expert opinion about some interesting ideas that we can work around with in markets like these. Well, we have Aditya Arora of Analytics.in who's joining us on the show. Aditya, good morning. Thanks for joining in. What's the first stock on your radar, and what do you expect there?
Very good morning. The first stock on my list is ITC. That was doing pretty well previously also, and yesterday we could see it coming out of consolidation on a shorter time frame. So that's a bullish candidate. One can buy 510 call at 10.55, can sell 520 call at 6.5. Maximum loss potential here is 6480, and maximum profit potential is 9520.
All right, so it's a bull call spread on ITC, interestingly poised as well. And, we're not entirely certain about ITC, but of course, in general, we are starting to see some traction coming through. And of course, Aditya is mentioning, we also have a max profit and max loss. Aditya, just a follow-up question on ITC. Would you wait for the expiration, or would you, in fact, are there any levels at which you would potentially want to pre-book your profits at a certain level?
I think one can lock the profit once price crosses 525 because most of the gains would be achieved over there.
Okay, fair enough. Let's move on. Aditya, the oil and gas space is a buzz. I believe you have one counter there as well.
True. So my second candidate is BPCL. As you rightly said, oil and gas space is buzzing and outperforming the market, and also showing strength in falling market. And yesterday, they came up beautifully, outperforming the market. So in BPCL, one can buy 360 call at 12.30 and can sell 370 call at 8.25. Maximum loss potential is 7290 and maximum profit potential is 10,710. So it's a bullish strategy on BPCL.
Okay, so you have another bull call spread as well on BPCL. Again, very interestingly poised, essentially, and perhaps largely on account of the kind of traction that we've seen in crude as well. Aditya, thank you so much for joining us and taking us through your trading ideas that you have for our viewers this morning. With that, it's back to you all.
Thank you for that, Agam. And, I think a couple of stocks that will be very interesting to watch. One, of course, the sugar pack. And we're going to be having a conversation with Sri Renuka Sugar in just a bit from now to understand the impact of it. We'll also get you a sense of which are the sugar stocks which could see a flow today. So that's one bucket that you need to look at. Tata Motors is the other one. I mean, why that kind of up move in the DVR, and is it because of the DVR being extinguished? So are you going to continue to see today? By the way, on Tata Motors, they also launched their EV bus product yesterday, and that maybe was showing you some of the reasons and what could be one of the reasons why you saw that up move. Meanwhile, some of the other stocks that are on NDTV Profits watch list this morning, and we should take a look at them. Infosys is one of them that we spoke about. GE Shipping. They will be selling a 2011 Supramax carrier. I just love the name of the carrier, Jagrani. So that's interesting. NLC India has clocked a thermal power JV, and that stock's been doing fairly well this week. Samina Capital has raised 30,000 crore rupees via NCDs, and Technocraft India has a buyback in place from September 2nd to 6th.
JSW Steel, they've got an Australian coal deal done. GPT Infra has announced a QIP. There are lots of other QIPs as well that we'll highlight for you. ITI, it's an EVM supply to the West Bengal government. Jacob on buyback news should be up and about. They've announced a buyback of 117 crore rupees. And 3M India, they've had a 3M Electro merger nod received. So these are a few stocks beyond that list that will be fairly active in trade. NTPC, their commercial ops for solar project are underway. Lemon Tree, once again, every morning, it seems like they have been signing licensing pact this time around in Ayodhya for 72 rooms. Sugar companies, I would imagine that's the big block to watch out for in today's day of trade. Ethanol output cap has finally been lifted, and ethanol companies will also partake in FCI rice auctions. So a whole bunch of companies from EID Perry to Balrampur Chini and Sri Renuka Sugar will be in focus.
Yeah, on the negative side, LIC has got a 606 crore GST demand order. Nowadays companies are getting orders at such a rapid rate that sometimes the street just shrugs it off. Shipping Corporation has got a 160 crore GST demand order. SpiceJet, 150 cabin crew have been put under furlough. Steel Strip has seen a JV called off with Regular Tech, and that could definitely be a negative. And for Exicom, Triton prices have been hiked. But we've been talking about the SpiceJet story. Let's get my colleague Mahima on board telling us more about the turbulence that's been brewing for SpiceJet. Yes, Mahima?
Right, Tamanna. So, SpiceJet has now placed 150 cabin crew members on a temporary 3-month furlough. Now, this comes, after the kind of crisis that the airline has already been facing. The furlough reports followed by the regulator scrutiny that has already been there on SpiceJet since some time now, and flight cancellations and operational deficiencies were identified, and DGCA has announced that increased spot checks and night surveillance on the airline to ensure safety will take place going forward. And during the furlough period, the affected cabin crew member will retain their status as employees, will also have their health benefits, and they will also have their earned leave impact. But despite all of this, the spokesperson at SpiceJet has said that despite the challenges, management is working toward enhancing their fleet with upcoming QIP, which was approved in July for roughly 3,000 crores. Now, yesterday, as an exclusive to NDTV Profit, we also came to know that the financial troubles deepens for SpiceJet, and SpiceJet passengers were denied boarding in Dubai airport, and this was after salaries of SpiceJet of some employees were being delayed. July salaries of some employees got delayed, and they've not gotten in the month of August as well. Now, this is not the first time that SpiceJet is facing these crises. Back in 2022, the airline had faced similar fate, and in 2022, DGCA had restricted operations of SpiceJet. Now, during COVID, the government had allowed limited flights, and they were operated at capped fares. However, airline is now operating at a lower level than what was allowed during COVID. In the month of July, also, SpiceJet operated at an average of 703 weekly departures, which is just 42.45% of what is actually allowed to SpiceJet. So this is the overall view and why the stock will be in focus today.
Thank you for that, Mahima, there with more details on the SpiceJet story. And of course, we're focusing on sugar this morning as well. So let me just recap for you what the news is on sugar and why the excitement. Because basically the cap that the government had placed on ethanol blending or use for sugarcane juice, etc., for ethanol has been lifted. So the new rule says that sugar mills can use cane juice and syrup for ethanol production. B heavy and C heavy molasses are also permitted. There is no cap on sugar diversion for ethanol. In fact, distilleries can buy up to 2.3 MMT rice from FCI for rice for ethanol as well. This aims to boost ethanol production and blending. The DPFD and MOPNG, the two government authorities, are the ones who are going to monitor sugar diversion for domestic supply. They want to maintain sugar supply while boosting ethanol production. Now, you know why this is a tricky terrain is because while sugar companies are being encouraged to produce more and more ethanol, that's the blended fuel is what we aim to cut down emission norms, etc., use them commercially. On the other hand, there's always a very tight balance between maintaining sugar supply in the market for retail use and for commercial use as well. You don't want sugar prices spiking up. So that's the really fine balance there as well. Well, let me go across to Kush Bora, founder of kushbora.com, joining us this morning on what is the technical outlook for the market. Kush, welcome. And, the kind of upswing that we saw during close yesterday, do you see that momentum continuing? We'll just pull up the implied open also very quickly before we get that answer from Kush and see what we're set up for. Remember, Asia was looking pretty good, and the Nifty implied open, not runaway definitely, but about 28 points up. Yes, Kush?
Hi, morning, Tamanna. Well, I think the uptrend will continue. Whether the same momentum will pick up today or not is a little dicey. We've had the expiry effect playing out, and despite that, the Nifty is above 25,000, very comfortably. What I'm taking heart from the fact is that the bases are shifting higher for Nifty, Bank Nifty, both now in Nifty's case, particularly if you see, 24,600, 24,800 were the levels previously. Now you've got a very strong foot base at 25,000. So I believe that this is going to act as the base, as the launch pad, as Nifty moves higher to 25,600, 26,000 levels also in the coming weeks, perhaps months. But on the whole, constructive. Any kind of dip or pullback towards 25,000 or 24,900 should actually be taken as a buying opportunity.
What about Bank Nifty? Yesterday, midday trade, it attempted to move higher, but then again got sold into. But there are a handful of banks that are holding out quite well. Do you feel after significant underperformance in August, Bank Nifty could be a good long trade for September?
Good morning, Samina. I have been constructive on Bank Nifty ever since it broke above that 50,800 mark. Now, yes, there is consolidation for the last, 4 or 5 sessions maybe. But the heartening fact is that, the base has very clearly shifted higher. What we were looking at, a range of 49,700 to about 50,700, 50,800. For the last, 5 to 6 sessions, that base itself has shifted from 50,800 to about, 51,400. There is this small resistance of the 50-day moving average, which comes close to 51,500. But I don't think that should be a very significant, resistance. I think a more meaningful supply pressure will come in close to 50 to 200, and that is the aim, or rather the target, that we're aiming for on Bank Nifty. So constructive on Bank Nifty as well. There are some headwinds, namely from the PSU space. Some of the private names might actually start to turn a corner, but the PSU space has been seeing a bit of a, sluggish kind of a move. So if they too decide to join the party, then I think, 50 to 200 is a fairly reasonable number on Bank.
Right. One stock that, not one, actually a bunch of them that performed quite well in trade yesterday, and it's very obviously rotational trade that we're seeing on the large cap space. Yesterday the day belonged to maybe RIL, the Bajaj Twins and Tata Motors. The day before that, it was the likes of an LTI Mindtree and DV's Lab. What is your bet on the leaders of the day? Any sort of large cap names, one or two, that you think will take ownership to hold the Nifty out today and then could make a good intraday trade?
So actually, Samina, that's the precise issue. There hasn't been a very clear leadership, other than perhaps, the IT stocks contributing. There hasn't really been some other, stocks or indices that have put their hands up and said that, okay, we'll join this party or we'll take the Nifty higher. If one or two of those names could perhaps turn a corner, then yes, the 25,600 target would be achieved sooner rather than later. Now, that said, I do have a pick from the tech space this morning, which is Tech Mahindra. This stock also has been doing well. It's consolidating, but with a positive bias. So I think from a near-term perspective, you could look at buying Tech Mahindra. The targets here are 1670 and 1695, 1615 or 1620 thereabouts is where you place your stop loss. Now, the other stock on my radar is from the cash space, which is Orion Pro Solutions. Now, we've been discussing about this stock for a few, for some, sessions. Hasn't really converted into a call up until yet. Now, the reason it actually comes into a call is because there was this big up move that was seen in the stock. But for the last few sessions, it's consolidating. So this is like a base formation for the next leg of up move. So Orion Pro Solutions for a target of 2020 and 2080. A stop loss comes in at 1890.
Okay. All right. We've been talking about sugar stocks and we'll get Kush's view on sugar stocks in just a bit. But Varsha joining us with more details and perspective on how this can aid sugar companies. But Varsha, the real question is, all right, it's positive for the industry as a whole. But among the listed sugar companies, which are the ones which could benefit the most with the lifting of the ethanol cap?
Well, thanks, Tamanna, for that. We'll come in a bit the stocks that could benefit from that. But what exactly the policy is? So this is nothing but the elimination of previous limit on the amount of sugar that could be diverted for ethanol production. And the earlier cap was 24 lakh metric tons. Now this has been removed. So the union government has introduced a significant policy changing, permitting sugar mills to use cane juice or syrup to produce ethanol for the ethanol supply 24-25. Now the government has been encouraging sugar mills to divert excess sugar for increased ethanol production. However, due to anticipated drop in sugar production in the current sugar season and to ensure sufficient availability of sugar for human consumption, there was a ban of almost 20, or rather limit of 24 lakh metric ton in 23-24 ethanol supply year. Now along with cane juice and syrup, the new policy also allows the use of B heavy and C heavy molasses for ethanol production. Now this just means that the government has removed the limit on how much sugar can be used to make ethanol for 24-25 year. Now the companies that would be in focus would be EID Parry, Balrampur Chini, Praj Industries, Sri Renuka Sugar, then Triveni Engineering and Industries. So basically these are all the stocks that would be in focus today, the main stocks.
All right. Thank you so much for that, Varsha, there with all the details of what we're expecting from sugar companies. Sudeep Shah joining us, Deputy VP and tech on our show today. We're also speaking with Dharmesh Kant. Sudeep, welcome. Dharmesh, great to speak with you as well. Dharmesh, I'm actually going to get your view on sugar right now, because this is, seasonal. It is also something which is transient. I mean, today, maybe the government is feeling some comfort with sugar stocks and is allowed this diversion for ethanol. But come festive season, that picture might change. Is that a concern?
Yeah, good morning. See, it's more of a cyclical play differently, but at the same time there are a couple of positives with the sugar companies. One is this diversion which has been allowed with no capping on it. It's a big positive for sugar companies from a trading perspective. At the same time, let's not forget internationally the price of sugar is going to rise because of the squeeze in the supply side from the Brazil. There's a fire which has happened in Brazil, and most of the sugar crop has been destroyed out there, along with the corn crop. So that will add to further fuel in the sugar prices going up in the international market. So I was just surprised, like on the backdrop of this international event unfolding, which will boost up the sugar prices and this ethanol diversion being allowed. So maybe some kind of a windfall gain as a trading bet you can have for a couple of months, and definitely, I mean, festive season, you are bang on the target that it can be reversed. So, but right now the play is on, so why not play it?
Sudeep, morning. Just let's start by getting your view on some of the sugar pack, at least on the charts, before we get to levels for the day and, of course, top picks.
Good morning. So, with the news surrounding this sugar companies, I feel there are a couple of stocks which look good. One is from a mid-cap side and one is from a small-cap side. So, from the mid-cap space, if we see, then it's EID Parry, which could really have a big momentum given this news. And the stock already has given a breakout now. Say in June, the stock had already given a breakout above 750, 760 levels. And post that, it was consolidating at higher levels. Now, given this news, I feel till the time 780 zone holds in this stock, we could see a potential upside up to 860 or 900 thereabouts. Now, the second stock that I like, which is from the small cap side, is KCP Sugar. Now, here, similar structure is it has given a breakout in July. The stock has given a breakout above 48 levels. Since then, it is consolidating between 48 and 53, and it's at the higher end of the spectrum. So, what I feel is that from a relative strength perspective, also this sugar company should do well. And we could see levels of 59 to 63 here. And on the downside, the support zone would be closer to 49 levels.
Just very quickly on the index and Bank Nifty, Kushan, we were discussing that Bank Nifty has disappointed in August. It's been an underperformer, but it seems like it's getting ripe for a breakout. It attempted one yesterday, didn't completely successfully complete that circle. Do you feel like at the start of the September series, Bank Nifty is a good trade?
Good morning. What I feel is that from the last few days, what we are seeing in Bank Nifty's trading pattern, the index, although it's not able to cross and sustain above 51,350, 51,400 levels on a closing basis, and we are seeing some selling pressure from higher levels. But yes, 4 days back when it was facing resistance closer to 50,800, 50,900 and was not able to cross that. Now, this same earlier resistance will act as a support, and I feel that 50,800, 50,850 zone positionally now becomes a very important support, and it's just a matter of time whether when we see this breakout coming. And if we see ICICI Bank closely yesterday now, although from higher levels there was some profit booking there, but it stood for most of the trading session. So I feel that ICICI Bank could be the one which could lead the rally from here on. And even in ICICI Bank, 1200 will act as a key support.
Sudeep, in terms of top stocks that you're recommending this morning, what are your biases? Any long, short trades for our viewers?
So from the top stocks perspective, one stock which has given a breakout yesterday after 8 to 10 days of consolidation is Tata Motors. So we've seen a decent move yesterday in Tata Motors. The stock has closed at the highest level of the past, 12 to 13 sessions. and it's ripe for a big move on the upside. Now the technical structure also is suggesting that the stock could move somewhere closer to 1200, 1180 and 1200 thereabouts, and on the downside now here the support is closer to 1085, so that could act as a stop loss, because if you look at the daily and the weekly charts, the stock has given a good breakout. It was consolidating for a while all the other auto stocks were moving, but now this stock has given a breakout on the upside, and we feel that 1085 will act as a strong stop loss, and on the upside 1200 levels could be witnessed. Now Bajaj, the second stock is Bajaj Finserv, which I like here. Now, similarly, here also there is a symmetrical triangle breakout on the longer term charts, and the stock could move till 1820, 1840 zone. On the downside, now the stop loss should be around 1720, which is the prior breakout zone. So I feel now, even if that gets retested or the stock goes somewhere closer to that, that dip should act as a buying opportunity. Until the time 1720 holds, we could see the stock move up to 1820, 1850 in the coming few weeks.
You know, Dharmesh, just your view on Tata Motors, and both the stocks Sudeep has picked were the top gainers in the top gainers list yesterday. But just your view on Tata Motors and whether you think that the DVR move is the reason we've seen that spike up, and is there anything fundamentally very positive you see about Tata Motors?
Tamanna, we have been very constructive on Tata Motors since that border scheme of demerger was announced. So SOTP based valuation is around 1350 to 1400 based on FY26 numbers. So that way the businesses are doing well, be it JLR or the Land Rover segment. Everything has been picking up well for Tata Motors in the international front. Domestically also they have been trying to get the passenger vehicle segment up. Only the MSCB is a bit of a concern out there. We do believe that, I mean, this DVR getting, bought back by Tata Motors, there's no scope. I mean, 1.5% is the only arbitrage which was left when I last checked. So I don't think that's the trigger for the move. But fundamentally, it's looking pretty strong with margins getting improved on a quarter-on-quarter basis. If they're able to hold on 14% margin, it's a big thumbs up for Tata Motors.
Okay, Agam, in fact, is joining us on more on that. And, we saw a clutch of Tata Group stocks see a sharp uptick in the final hours of trade yesterday. Of course, Tata Motors was quite dramatic, but that was also ahead of the conversion of the Tata Motor DVR share into ordinary stock. Agam joins us to unravel all the details. Yes, Agam?
Yes, actually, Dharmesh has shed in some insight as far as Tata Motors and DVR, issue is concerned at the moment. But to take us through how things are going to pan out, we do know that the ratio at the moment is 10:7, which means that when the DVR shares get expunged because of the fact that the ratio is not 1:1 but 10:7, well, the equity base, of course, will contract by as much, and the promoter holding will come down by around by just as much, and of course this also means that your earnings per share will naturally increase considering your equity has come up. But as Dharmesh has already pointed out, to a certain extent, that small arbitrage opportunity is now out of the way, considering the kind of way that we've seen the shares move. Perhaps more importantly, a little later on yesterday, we also saw a little bit of an uptick in Tata Motors on account of its launch of a new EV vehicle coming through, and this is of course from the commercial vehicle space. This actually augurs well in terms of sentiment as well, because given the fact that they have already established themselves in the passenger vehicle space, the new EV in the commercial vehicles area will also give them a little bit of an impetus, also a foothold in the Indian markets. And naturally, this bodes well for the plans that the companies have. And, well, to a certain extent, they're also showing up with respect to what they have already indicated. And, of course, we're also waiting for that split between commercial vehicles and passenger vehicles down the line this year. If not this year, then perhaps, next year. But we will certainly see that split come through. And given the fact that they now also are elucidating further their plans as far as their EV space is concerned in commercial vehicles too, that also bodes well for the prospects of the company going forward.
That was a day that belonged to Tata Motors. Unfortunately for that, the Nifty actually scaled new highs and closed at a new record high. Implied Nifty is indicating to a flat to higher start. There will be a bunch of counters we'll be tracking in today's day of trade. A lot of those counters will be also focused because of the passive or the changes in the MSCI index. And as Nivama puts out every quarter, a whole bunch and barrage of companies might be beneficiaries of passive flows. Along with that, you will also have a bunch of QIPs that market participants will be reacting to. We'll take a break, we'll come back, track pre-open and take you through all the market action as we gear up for trade this Friday morning.
Welcome back. You're just about 30 seconds odd from pre-open, and now we're going to have a fantastic Friday, or a bit of the sort of nervousness that you saw through the week. Remember, we have seen a week where the Nifty has come to the fore more than the broader markets. The broader markets actually have been suffering a tad. And is that the kind of trend that we see continuing? Kush Bora, Sudeep Shah, Dharmesh Kant with us this morning. Kush, let me come to you first on Tata Motors. And we've spoken in detail about the fundamentals. I mean, I don't know if it's the DVR move that's driving it, their EV bus or more. Nevertheless, on the charts, would you be constructive on a Tata Motors right now?
Oh, for sure. I think, among the space, if you look at a Maruti or an M&M or a Tata Motors just for a comparison sake, I think the other two are still consolidating. Maruti had a blip, but it's not able to take out that 13,000 resistance mark. If anyone were to take a bet, I think, the only stock that actually stands out right now at least is Tata Motors. Now, that there is a resistance near that 1120 mark. But once that is taken out comfortably, and we saw close just about, there yesterday. But once that is taken out meaningfully, I think, more momentum will kick in. I think yesterday what we saw, could be for a lot of other reasons. We discussed an expiry play also. But other than that, I think there could be some resistance around that 1120 mark. I don't know if we are opening above that today. But once that is taken out, you are looking at 1150 and 1180 as the next two targets. And there is a strong base formation around the 1100 mark. So 1090, just a little under that 1100 mark is where you place your stop loss. So on the whole, constructive. Momentum will kick in if we are able to sustain above this 1120 level.
It's going to be an interesting morning. Pre-open is all over the place. We shouldn't be getting ahead of ourselves on that. Expected to see a gap up of 250 points. Now, if this is how it plays out, the street is definitely going to get very excited. The next stop, remember, on the index was going to be 25,300. But from the way it's looking, it could potentially get taken out in terms of today's trade. Well, a couple of other stocks, Sudeep, that I want to talk to you about that have, or rather, I would expect to remain active in today's session is RVNL, Max Estate, and Prestige Estate as well. Max and Prestige both have QIPs. You've got a buyback as well from Technocraft, and you've got RVNL that's bagged an order, and they're going to see an inclusion on the MSCI, which will fundamentally, of course, impact the stock. But those four, any of them that you would trade this morning?
Yeah, so if you see Prestige as well as Max, now Prestige in the last, I guess, 1.5 to 2 months has been on a declining momentum. On the downside here, the stock should have support somewhere around 1609, but the medium to long term trend is good. So I feel on dips closer to 1680, 1690 zone, this could act as a good entry point. And on the downside, 1650 will act as the strong support. Now, this 1650 zone till it's held. On the upside, Prestige could see, I guess, around 1850 to 1880 zone. Coming to RVNL now, RVNL post that big move that we had seen in the say from the period of Jan till July mid, we have seen some kind of a consolidation. However, during this consolidation, when there has been some negative price action, the volumes have not been higher. The volumes have been on a lower side. So I feel I'm just reading this as a short-term consolidation, and the stock is still sustaining above all its major moving averages. So that's giving me a comfort that yes, from the current levels also the trend has not been shaken. And on the downside now, 550 will act as a strong support until this stock holds this levels. We could see the stock moving up to 620 and 650 in the coming few weeks.
You know, okay, focus on sugar. Look at what's happening pre-market. Sri Renuka up nearly 12%. EID Parry. Some of the sugar companies really buzzing this morning. Balrampur Chini also up about 2%. So you have sugar as a focus. Prashant Biani, Vice President, Institutional Equity at Elara Capital, joining us to tell us what are the top picks on sugar and how beneficial is this fundamentally. Prashant, a very good morning. Let's just get your first take on which are the companies likely to benefit the most with this restriction on sugar diversion being lifted.
So the entire sector is going to benefit from it, along with the resumption of ethanol blending. FCI rice has also been allowed for sale. So I think because of that, the dual feed manufacturers are going to benefit most for the likes of Balrampur. Triveni also has, I think, some dual feed capacities. So I think both these stocks should benefit. But the benefit is going to be for the entire sector because of this.
So here, Sri Renuka, Balrampur, all of them are buzzing, Praj, etc. But where do you see the most upside?
So right now we have Balrampur in our coverage along with Dwarikesh. So we will restrict to that in terms of upsides. Both these companies, I think, we are positive upon.
Prashant, this is one sector that, constantly gets impacted by regulatory changes, and in the sector that the promoters have not made enough money in that sense, right? And investors as well, I don't know whether they've made sugar as a sector has not created significant wealth in that sense for investors. Do you feel like this move or this removal of this cap could be long-term in nature? And if yes, if it does impact the earnings, will it be over the next couple of quarters? Will it be immediate? I know sentimentally it's a positive day, but getting beyond today.
Yeah, so but sugar has been a cyclical sector previously, but once in the last 5 years, once the ethanol blending has been followed strictly, so I think the cyclicality has certainly been removed, and the sector has given good return as such. There was a temporary disruption last year, but it was temporary, and we were already expecting ethanol blending to resume. So I don't think that it is not a wealth creating sector as such. It is just that sometimes it is cyclical, but because of ethanol blending, I think we are now on a secular uptrend in terms of business growth for these companies.
Large industries, Prashant, EID Parry and Sri Renuka are all expected to get a 5 to 10% gap up. Too late, you think, to jump in, or is it okay? I mean, for a medium-term time horizon, these stocks could still be bought despite this 5 to 10% gap up this morning, or would you wait it out?
No, one needs to have a long-term view right now. I think at this point of time, the stocks have rallied in the last 1 month as well, quite sharply. So for the likes of Balrampur and all, which are venturing into PLA as well, and the benefit of this resumption of blending is likely to come in from H2. So the benefit will be back-ended in terms of both FY25 and FY26, but the full-scale benefit in terms of volume growth will be more towards FY26. So I think one needs to have a medium-term view if someone wants to enter the sector here. Having said that, we don't expect any negative news as such for the sector in the near term, because I think before elections, all the negative news that should have come had come in terms of temporary disruption of blending as well as cane price increase. Now I think the future triggers would be in terms of increase in sugar MSP, then revision in ethanol price, and if government allows export, then I think that will be the additional trigger.
One last bit around festive season. Do you see any concerns of a rollback on this, sugar diversion decision if prices start rising up, or that's out of the question right now?
Certainly not. We are, as a nation, we already are likely to have 8.5 million tons of closing stock of sugar by the end of this season, and maybe a similar number or around 7.5 million tons of sugar stock by the end of next season, even after considering 4 million tons of diversion for ethanol blending and before allowing export. Typically, we need around 5.5 million tons in terms of closing stock. So we still have headroom for 1 or 2 million tons of export. So even if there's a temporary price increase, I don't think there is going to be any rollback from this decision. I think because that will also be very sentimentally negative. Plus, I don't think anyone would be in a mood for that right now when government wants to increase the ethanol blending from petrol, from diesel and various other sources.
You're right, Prashant. Hopefully there's going to be no rollback on this decision, because that definitely sentimentally will be a huge negative. Sugar sectors cheering this move by the union government. Thanks, Prashant, for highlighting the impact of this on the sector. Stocks as well that stand to gain. Sri Renuka Sugars is Prashant Biyani's top pick. The stock is already up. Is expected to be seeing a massive gap up in terms of trade. A 10% uptick cannot be ruled out at this stage. OMCs also will stand to benefit, on back of which your OMC counters, despite high crude prices globally, are doing okay in trade, alike of BPCL, HPCL and IOC, all trading with a slight positive bias. Sudeep, couple of stocks again, and I'm going to stick with the large cap today because the last few days has been about large caps taking leadership. HDFC, BPCL and Wipro. Do we have a trade going there on any of these names? Sudeep, you're on mute.
Yeah, sorry. Yeah, so out of all these three names, I feel BPCL could do really well, although the pre-open is suggesting a couple of percentage points higher opening. But I feel the trend is firmly on the upside, despite the small uptick in the global crude prices. Overall here in BPCL, we see this rally extending up to 375, 380, and any dips today post opening towards 355, 356 should be used to go long with a 345 as a stop loss. And the positionally, the targets here could be 380 to 400 on the upside.
M. Manikam is joining in, Chairman and Managing Director at Sakti Sugars. And while we've had a lot of focus on sugar, I just want to get an industry view as well. Mr. Manikam, very good morning to you. I'll start with the question that I've been asking, that this is, of course, undoubtedly a great relief for the industry. Do you see it persisting and no pressure on supplies coming in, getting the government to go back on it?
Actually, I think the original decision was not good because we had a lot of sugar in hand. And now I think government probably evaluated and found out that they have too much of sugar which can't be used. So they've come back to ethanol. So, I mean, what they should have done originally is to assess the sugar available before they took a decision. But I think it's a welcome change that they're taking this decision.
So Manikam, hi, it's also Samina joining in. So while this is a rollback on a rollback or a rollback on a wrong decision in that sense by the government, the sector clearly is enthused at this stage. Sentimentally huge positive. In terms of impact, and quantify this revenue for us, for your company, because I think that's easiest to tell, and also for the sector at large if possible. And when will the impact of this be seen in terms of operational performance?
See, actually, we are not in ethanol as much. In Tamil Nadu, ethanol offtake is lower. But this as rollback we are talking about, we've been running on this roller coaster for the last 40 years. And the policy changes keep coming because the government has a handle on this industry, which has on no other industry. So we've been trying to get out of that. But unfortunately, we're not able to get out of the changes that these guys have been talking. But while that we are saying this advantage is that we are able to control our inventory. Excess sugar can be sold. The farmers can be paid in time. So this is going to be good for the industry that we'll have liquidity. Otherwise, we'll be sitting on stock of sugar which is not going to be sold.
Right. Thank you so much, Mr. Manikam, for joining us. That's the view from Sakti Sugar, saying that roller coaster continues. But in that roller coaster, sugar companies are on top, at least today. So we've talked a lot about sugar. But, Kush, let me come to you for a quick call before we open. Pre-open rates have settled. And we're looking like we're set for a decent opening on the Nifty. So any change in the Nifty, Bank Nifty call after seeing the pre-open rates?
No, not at all. I think, this is in continuation with what we were talking. And as I said, 51,400, 51,500 were, those levels were looking like a resistance, but nothing more, meaningful, nothing so significant. So on the whole, very positive. If you've got long positions, continue to hold. Don't add just yet. Maybe if you get a pullback of, let's say, 50, 70 points on the Nifty and perhaps 100, 150 points on the Bank Nifty, that would be a good time to add.
Sudeep, what about you? What is the top call post pre-open that you're seeing?
See, the top call post pre-open would be Bharti Airtel, but not at the current levels. Just a slight dip, as Kush was mentioning, that since we're opening a positive gap up, there might be small retest. So Bharti Airtel somewhere closer to 1560, 1570, between that zone, with a 1540 as a stop loss. The stock has already given a breakout in the last few days. So I feel this momentum on the upside could continue up to 1620, 1640 in the coming few weeks.
Right, so thank you, gentlemen, for that. We're gearing up for market open. It could be the 12th straight day of gains coming in for the index. The breadth of the market is not expected to be too bad. And also remember that the pre-open is indicating that the broader markets this time around could potentially be performing in line or may try and play catch up as well. We identified stocks like HDFC Bank that are looking firm in early trade. Remember, we've talked about how it's about time that Bank Nifty starts participating. There was a failed attempt by Bank Nifty to gain in yesterday's day of trade, but that rather was met with some resistance in the last few minutes or so. Well, as we are gearing up, it looks good. It looks very good this morning. 25,253, almost a 100-point gap up. This is probably one of the better openings we've had in this whole week. 25,300 is going to be the next stop for the bulls. So that is a level that they will try to attain as soon as they can. Bank Nifty, and this is what we've been waiting for. It finally does slightly better than the benchmark in opening trade. After about 20 odd days of trading lower and underperforming the index, the catch-up could be underway in today's day of trade. If I had to call it out, it seems like the day could belong to Bank Nifty, and Bank Nifty could help the Nifty close once again at a new record high this morning. Broader markets aren't doing too badly. The last few days this week, we've seen them underperforming the benchmark, but the trade is back on where the buying is emerging in the broader market universe. Lots and lots of smaller stocks that will see action in today's day. The small, mid-cap and micro-cap all looking pretty good in today's session. The Nifty frontline also not doing as bad as we see it. A quick check on how the Nifty 500 is playing out. The breadth is good. The bias, fortunately, is on the upside. And you see BPCL up 1%. This is largely on back of what's happening on ethanol production. We've got excess sugar and, of course, putting that to use now. And OMCs will benefit from that. JSW Steel is up 1%. Not sure what's happening there. HDFC, actually, it was a stock of the morning. So that is one reason why the stock is doing well. HDFC Bank, L&T, Bajaj Finserv, that was a buy call by a few of our analysts this morning, trades with a positive bias. Very mixed, so no sectoral indications just yet. On the sell side, ITC is looking slightly quiet, defensive. Hindalco or SPI Life, Apollo Hospital are having a quiet morning. No specific trend emerging just yet, Tamanna. It's largely stock-specific trade. But I think one good thing is that Bank Nifty is doing better than the index this morning. So that could be a relief for investors and traders on Bank Nifty.
Yeah, I just want to look at what's happening with Tata Motors as well. And, you know, it's not really showing that kind of a response after yesterday's run-up. Can we just pull up the Tata Motors chart for a second and just look at it a little more closely and see where it's going? Yeah, so complete, you know, at the bottom of the chart, really, not massively, but some profit booking after yesterday's run that we saw. Let's look at the broader indices, because remember, this entire week has been about the top liners, the Nifty and the Sensex, more than the broader indices. Some recovery there in the mid-cap 150 as well, about 0.5% up. Let's look at what's happening with small-cap index, and that's also about 0.5% up. But the morning is about sugar, isn't it? At least it was in pre-open. So Sri Renuka, EID Parry, Praj, Balrampur Chini. Let's take a look at what's happening at some of those sugar stocks and whether the opening has been as sweet. Oh, absolutely diabetic. 7.5% up on Sri Renuka, 7% nearly up on EID Parry, Praj Industries, Balrampur Chini. All of them having a sweet run. We'll ask our analysts if they're going to see some profit booking sometime soon. Fundraise is the other theme that we saw in this market. So let's look at what Prestige and Max Estates are doing. They've announced their QIPs, negative for Max Estate, but positive for Prestige at this point. SpiceJet is the other stock that has been on our radar. That stock now 4% down. The QIP buzz kept it afloat yesterday, but now trouble is brewing. They've put 150 cabin crew on furlough. Telco companies need to be looked at, because remember, we told you that the AGR plea will be in the Supreme Court today. Completely muted right now, but remember, it's a closed hearing at about 11 o'clock today. And if there is some boost there, it will see a very positive response for some of these companies. So those are some of the top gainers. But I think in terms of a theme, Samina, largely it's all about sugar.
Yes, and it's been a good month for sugar stocks as well, just like the analyst had pointed out for us. But a quick check on some of the other stocks that are looking good in trade this morning. While the top gainers are focused, or rather the names largely are sugar companies, you have a few more that aren't doing too badly. ITI is up 5%. Godfrey Phillip continues to gain 3.5% higher there. Fertilizer stocks are doing quite well. Real estate is having a pleasant day, and pharma is playing catch up today. So look at Lupin, look at some of those other names that are trading largely in positive territory. Fortis Healthcare, Lupin, all in positive territory. OMCs, the trade is not just sugar, it's also BPCL and HPCL that are trading firm on the OMC side of the business. On the sell side, you have some profits being taken off the table on Gujarat State Petronet. 197 communication is lower. KPI Tech, so mid-cap IT may be having a soft morning. CDSL, Tata Motors, Kalpatru projects are some of the few losers, but nothing significant really at this stage to talk or be concerned about. Prestige Estate on that QIP is up 1.5%. Max Estate on back of the QIP is down 2.5%. SpiceJet, Interglobe, Tamanna has already mentioned as stocks that also would be in the moving space this morning. But it's a record high on the index. We are at 25,237 as we see it, looking steady with the whole market sort of participating in the trade today. Sudeep, any trade you've identified in opening? Anything you like for the day, for next week?
One stock that has come to the radar is Coal India. Now, Coal India, yesterday we have seen the stock closed closer to 527, and in the last few days it has been consolidating. But here, if you see this stock today, the opening has been strong. There is a catch-up going on here. And on the upside, I feel that the levels of 555, 560 could easily come. Yesterday, the stock has actually made a hammer-like candlestick pattern, and from the lower levels, there was a decent recovery on the upside. So I feel this recovery could continue today also, and we could see levels of 555 to 565 here in Coal India in the next few trading sessions. The stop loss on the downside could be 523 levels.
Right. Thank you so much, Kush, Sudeep and Dharmesh for joining us this morning. And we're looking like we're off to an interesting start, at least this Friday, to round off what has been a bit of a range-bound week. But, 1 week here and there, really, in the larger picture, is not the big story. The big story is how India has performed. And recently we had a conversation with veteran investor Jim Rogers, who said on this channel, on this show, that he's embarrassed that he has missed out the bull run in India. Our next guest has a very interesting perspective on it. But before I introduce him, let me play out for you what Jim Rogers actually said in that conversation with us when we asked him how he is positioned on India. And he said, "I'm embarrassed that I missed the India story." Listen in.
I make many mistakes. I have missed many stock market moves in my career. I've certainly missed the Indian market. I'm embarrassed because I've invested in India many times in my life. And here, finally, Delhi has the right attitude, and I missed it. I watched it. I see it happening, but I've missed it. And as far as I'm concerned, I don't like to jump on a moving bus. If you jump on a moving bus, sometimes you get hurt.
Okay, then the story gets interesting because Nilesh Shah, the MD of Kotak Mahindra AMC and of course a star on a social media platform X, came out and responded to that comment saying that I had written to Jim Rogers in 2017 when he was bearish on India, and I'm glad he's understood it. So let me get Nilesh Shah into the conversation. Mr. Shah, great to have you on the show and, sort of round up this whole conversation. And big of Jim Rogers to say that he's embarrassed that he missed it, he made a mistake. I think a lot of global investors may be sitting on the sidelines with that absolute concern. And just the second part of what he said, I don't want to climb onto a moving bus. If you can start by addressing those 2 points.
So undoubtedly, when you jump on a moving train or a moving bus, you will get hurt. But is market going to be kind enough so that it will lay a red carpet for you to invest into? Equity market is about taking risk, about taking calculated risk. I will request Jim Rogers to come and visit Churchgate Station and see how Indians jump into a moving train. Maybe there is a trick for him to learn.
No, so, okay, Nilesh, your cryptic humor sometimes our viewers might not get when you make that analogy with Churchgate Station. So are you saying, because a lot of global money is still sitting on the sidelines and valuations is a story that we hear every day, are you saying that, it's time for them to get on board?
So my recommendation to investors is, India is like any other market. It will neither disappoint an optimist nor disappoint a pessimist. If you want to be bullish on India, we'll give you 10 reasons. If you want to be bearish on India, we'll give you another 10 reasons. In fact, I wrote a letter to Jim Rogers in 2015 as well as 2017 when he was only talking about the negatives of India. He's a legendary investor. And somewhere as an Indian, I felt, not as a fund manager, but as an Indian, that you don't come and berate my country in my media. You speak balanced things. You speak positives, you speak negatives. The whole intention was to present the true picture. I'm glad that finally he has realized it. Even today, his observation that India is a moving bus is absolutely right in certain kind of stocks. We have been also highlighting that there are many low-floating stock counters where valuation looks unreasonable. There's a momentum over there, and you are unlikely to make money over a longer period of time. But at the same time, there are many good companies available at reasonable prices. It's not a cheap market, but gold will always be available at the price of the gold, not the copper.
So India is Sona तो आप तांबे के रेट मत expect करो. Having said that, even as we're speaking today and just now, Nilesh, fresh highs on the Nifty, on the Sensex, record levels have been hit, and the message for those who are seeing this with a bit of butterflies in their stomach. Every day there is also a conversation about whether these levels are sustainable.
So if you're taking 3 months, 6 months, 9 months, 12 months view, I have no idea whether these levels are sustainable or not. Today, there is Triveni Sangam of flows, fundamentals, and sentiment towards India. Domestic investors are powering in money, and it may create some kind of excesses, as we have recently seen in some of the IPOs. Do those IPOs deserve that kind of valuation and money? My answer is clear no. But then this is the market. It can remain irrational more than I can remain solvent. On the other hand, there is also fundamentals which is reflecting corporate earnings growth. Between 2020 to 2024, earnings have jumped almost 4 times from about 4 lakh crore to 16 lakh crore. Corresponding, there is jump in the market as stocks are slaves of earning. Now, over 5-year, 10-year horizon, are these levels sustainable? My answer is undoubtedly yes. I think when you're investing in equity market, you look at valuation, not necessarily the index. Are our valuation at lifetime high? Well, answer is clear and unambiguously no. They are still at reasonable sense in large cap, little expensive on small and mid cap, and hugely expensive in some low floating stock counters. Maybe 25% of market is frothy. 75% market still provides opportunities for long-term investor. Of course, you'll have to reduce your return expectation. If we see 20-year period between 2005 to 2024, the broad market return is about 13% plus, not a very unusual number. But 5-year or 4.5-year number from Jan 20 to 2024 is roughly about 21%. Before that, for 15 years, market delivered just about 11% return. So do moderate your return expectation. Go for quality over momentum. Go for high floating stock market discovered prices vis-a-vis low floating stock and controlled discovery of prices. Go for reasonable valuation over expensive valuation, and you will still do well in India at this level of index.
Nilesh, hi, it's also Samina joining in. Very clearly, we've borrowed returns from the future. You're right, the 10-year CAGR on the index is 12-13%. That's pretty much as well as gold has done. And I want to get a view from you on gold, because while you believe that there is opportunity to buy gold-like stocks in India, what do you think about gold? Without the in and outs, without the volatile returns, this one has done as well as the index. From where we stand right now, would you recommend adding gold to one's investment portfolio? Not significantly, but at least to the tune of 10 to 20%?
So, Samina, we have been advocating gold investment since March 20. Partly it was driven by correction during COVID time. Thereafter, Russian foreign exchange assets getting frozen by Western world pushed us to advocate gold even more strongly, as we believe central banks around the world are going to invest in gold. Now we believe as Fed starts cutting interest rate, there will be another boost to the gold prices. Obviously, the big Damocles sword hanging on gold prices was import duty. It has come down in the recent budget. Now the import duty is just about 6%. So we continue to advocate buying of gold. But Samina, I want to talk about one thing which should concern especially women buyers of gold. In many families, in many households, women go out and do Vichy or a SIP kind of investment with gold jewelers. You give small amount of money for 11 months, and then on the 12th month, you are able to buy ornament. Now, many a times, these jewelers are not reliable. Their credit worthiness is not established. This deposit of money is not covered under any regulation. And we have seen sometimes dwellers running away with investors' money. So please be very, very careful. Might as well do SIP in gold ETF than doing with roadside dweller. The second thing is our tradition in houses on Diwali day, on Dhanteras day, on Akshay Tritiya day. We all go and buy gold. On a birthday, anniversary, we go and buy gold in small quantum. Now, when you buy gold in 1 gram, 2 gram, 5 gram, the transaction cost which you pay is 20, 30, 40%. It doesn't make economic sense to buy gold in smaller quantum. Might as well buy that via gold ETF or gold fund of fund. So gold, we are bullish, but I think we need to recognize that buying of gold, the habit of buying of gold needs to change. Instead of small denomination paying 30, 40% transaction cost, might as well come into gold ETF.
Of course, with the fact that SGBs are not showing up anytime soon, gold ETFs may be the way to do this. You know, one more factor that some may argue could be concerning, others may argue it improves the balance sheet of companies, is promoters selling significant stake. It's at a multi-year high. Year to date, promoters have sold over 1 lakh crores of equity, their equity in the market. One way to look at it is that they believe that the stock price of their company is peaking out, so they're taking profits off the table. The second way to look at it is whatever supply comes in, it gets picked up and lapped up not by just retail investors, but by even foreigners and mutual funds like yourself. Nilesh, is that a concerning trend? How are you reading into this?
So, Samina, your point is absolutely valid. Whenever you see promoters selling, you need to do your research 2 times more, because he knows infinitely more about his company and valuation than you will know. Now, what we are seeing is that today, yes, undoubtedly some promoters are selling, but many a times they are just setting up their family offices and their money comes back into the same market, albeit in a different stocks, different asset classes, purely from a diversification point of view. Second, we are also seeing some promoters who wants to fund their extended families or next generation's business ambitions. They don't want to create cross-holding like it was the trend in the past, as it destroys shareholder value. They are selling their stake and putting that capital to use in supporting business ambition of their extended family and next generation. Third, we are also seeing family transition. Couple of friends have come together to start a company. 2 brothers have come together to start a company, but their kids are not willing to work together. And hence, someone who is classified as a promoter, but who doesn't want to be a promoter, is on his way out. We are also seeing some of the foreign companies coming and reducing their stake in India. So each promoter case, one has to look at carefully. If you find a promoter selling because he believes his company is overvalued, then you have to retest your hypothesis, do your due diligence, do your work more, and try to be understanding why promoters are selling.
Which is always tough to find out, right, Nilesh? Sitting outside, you really don't know whether they're selling for transitional purposes because they're diversifying, putting the money in wealth in a family office, or simply transferring to the next generation. But just moving on from that point, another thing that catches my attention often is the fact that everyone likes banks. Everyone's talking about how private banks is a good trade, but the trade is not playing out. What, in your opinion, is restricting the private sector banks at this stage? And also, you started this conversation by saying there is some value in the market. So, don't paint everything with the same brush. Do you think private banks have that value that investors are seeking from a 1 to 3 year time horizon?
Undoubtedly, yes. But as of today, momentum is against private sector banks. One, their NIMs are coming down as cost of deposit is going up, and they are not able to pass that to the borrowers. Number 2, there is a consultation paper on liquidity coverage ratio. If that gets implemented, it is likely to hurt private banks' profitability, as they will be putting more money for liquidity coverage. Combination of slowing or reducing NIM, along with potential reduction in NIM thanks to allocating more money for liquidity coverage is right now constraining private sector banks' valuation as well as the stock prices. We believe once the liquidity coverage ratio guideline is behind us, its impact factored into the prices, there will be opportunity to add private sector banks and select PSU banks.
Nilesh, we talked a bit about banking and financials, but just want to get your sense on one big trend that we have been seeing in the markets and whether you think that story is over. This is the push for anything which is premium. Premiumization, discretionary spending, catering to a smaller part of the population, but one that wants to spend more on not just the basics. Do you think that that's a trend to stay, looking at our population demographics?
So again, every story is bottom up over there. We still believe premiumization trend will continue in the economy. But there could be disappointment in the market as market is factoring in certain level of growth, which may not materialize. If you look at entire consumer basket, I think time has come for mass market product to move, but for those companies which are able to leverage distribution. Through Pradhan Mantri Gram Sadak Yojana, more villages have been connected. Now our companies expanding their distribution network to take leverage of that connectivity. We have seen some established player moving more like a tortoise and some young guys moving like hare and establishing distribution network. The second thing is about cost proposition. There was a time when a global brand will always command a premium. Today, there is value-conscious consumers which are willing to experiment with value-for-money brands. The third thing is also appeal to the user segment, consumer segment. We have seen many global brands, old brands, not able to maintain connect with the younger generations, millennials. So I will say premiumization story will continue to play in economy. In market, try to be bottom-up stock picker, especially with companies which are expanding their distribution network, which are able to maintain connect with the new set of consumers, and which are providing, in some sense, value for money. As one of the very popular advertisement of an automobile says, even if you buy luxury car, the question is, kitna deti hai?
Typical, right? Very quick one, Nilesh. For a very long time, IT, which has always been and has always managed to do strong returns over the last decade, was in a little bit of a back foot. And there were unprecedented times, right? They had not seen anything like a delayed extended slowdown in the US. Of course, now we've got the US elections, threat of AI. But there were some parts of the market that believe that legacy businesses, legacy clients will come back. There's no keeping a TCS, HCL Tech and Infosys down for too long. Where does your bias stand? Do you feel like this AI threat could have been overdone and it's maybe not a bad idea to bet on the dark horses in that sense, or the legacy players in the IT pack, or would you stay with the newbies, the guys in the broader market IT pack, tier 2 IT stocks?
So we believe in IT companies which are equipping their workforce with AI tools and helping create faster, cheaper, better solution for their customers are likely to survive, are likely to become winner. We have heard many commentaries which says, in today's world, one person with AI tools is able to deliver almost 10 people's work. Software is getting commoditized. With AI and Gen AI, the value added will be more like people who are using AI tools rather than not using AI tools. At the same time, there is exciting opportunities opening on the hardware side. The Internet of Things, the AI getting built into hardware. So we'll have to see which companies are able to make that transition. Software getting commoditized versus hardware opening up new vistas. Companies which are able to make that transition, I think they will be the winner in this cycle.
Nilesh, I just want to get your take on an important notification from SEBI recently, which was sort of, a warning for investors in SME companies, talking about how promoters are, and that's a trend that SEBI is looking at, promoters are putting out news or sort of talking up the operation, stock price goes up, investors come in, and then the promoters are dumping their stock or their share. Just, these are sort of the beginning signs of trouble coming ahead. How do you see it? And is this something that we can now control quickly at the level of maturity we are at in our markets?
So, Tamanna, there is a Gujarati proverb which says, Lobhya hoy, tyan dhutara bhukhe na mare. Where there is greed, the thieves don't have an off day. It's applicable in the market. In SME exchange, there will be some good companies, no doubt about it. But as of today, there are also some bad apples from a valuation point of view. If we go to any SME banker, any SME entrepreneur, they don't say the last 10 years were the best of their life. However, SME index IPO is the best performing indices in the world. If your equity indices are doing so well, undoubtedly it should be corroborated in the real life also. I believe prices on SME exchange in many cases have gone up substantially ahead of their fair value, and hence SEBI's warning is appropriate. At the end of the day, it is buyers who have to be aware that if price is what you pay and value is what you get.
All right. Thank you so much. Always fun and a pleasure speaking with Nilesh. I mean, no one can beat you at the dialogues, the proverbs, and the sayings that you put in to make it a really enjoyable experience, not just for the viewers, but for us also to talk to you. Great speaking to you, and hope to chat with you soon once again. Nilesh of Kotak Mahindra AMC there on all things market. His advice to Jim Rogers in 2017, which he has now realized belatedly, and so much more. You should catch that entire conversation on all our social media handles if you've missed part of it on TV. But we're speaking now with Manas Agarwal, Vice President Research Analyst at Sanford C. Bernstein. Manas, a very good morning to you and great to have you on. Now, two notes that you're talking about and 2 points of view. One, of course, on AMCs and one on insurance companies. Let me start with your take on insurance companies, which have been seeing a lot of buzz for various reasons. One is the expectation that GST on insurance will come down. The other is that the surrender value issue, at least for the life insurance companies, will sort of be eased. But what is your fundamental reason for being bullish on Indian insurance companies?
Sure. Good morning first, and thanks for having me here. I think the mentions that you made around GST and surrender value, GST is smaller issue, not really driving my view. My view is more long-term. I think there is an adoption-led growth that the insurance industry and the mutual fund industry should have and will have, in my view. That drives your long-term growth. Surrender value issue is probably, at least in my view, the last known regulatory issue. People were fearing a large impact. Companies have come out and guided, at least, for a smaller impact on their margins. We'll have to see how that pans out. I think growth is coming back into the sector after a couple of years of regulatory flux. So all in all, pricing or valuations for life insurers are attractive and the long-term growth story remains. So that's what builds my view on life insurance, on asset managers. We've seen fantastic flows from households into the industry. Markets have been very kind as well. So mark-to-market gains are driving AUM growth and profit growth. I think more of that will continue in the long run across the cycle. I think household exposure to equities is very low and it will only continue to go up in the medium term, long term. That's how I think about these businesses on a long-term basis. I hope that answers.
Yeah. Manas, let's talk about what is happening right now, right? With more awareness, with more education, literacy, investors realize that the best way to build their portfolios is to keep insurance separate from equities or investments, right? And that's probably the right way for any country to go about in the medium to long term. what we've seen recently is that ULIPs are the key contributor in terms of revenue for insurance companies. Now, I do understand these are not high margin businesses, but they've done a good job in terms of the revenue. So my limited point here is that if we are moving towards a country which should keep insurance and investment separate, ULIPs will fall off the handle, I'd imagine, right? What happens then? Shouldn't it be an either or as opposed to a both when you look at insurance and equity or asset management companies in that sense?
Sure. So the fundamental point you're making, I can agree with that. But then customer awareness and understanding of these products, especially insurance, is very limited, right? About 4-5 crore people in India have access to mutual funds at this point in time. A similar number has access to insurance from a private player perspective. I'm removing LIC over here. LIC is predominantly a par product story. So yes, ULIP may not be the right product to gain equity exposure, but then that awareness is more present in financially savvy people like you and me. And the average person does not necessarily understand this factor. So it'll be a gradual shift. I don't think it'll be an either or overnight or in 1 year. That will happen till the time markets do well in the near term. ULIP sales will be higher. Insurers are also cognizant of this fact, and they have an active push away from ULIPs at the margin, trying to push more non-par products and more annuity products and more term products, which are also margin accretive for them. So answering your question, yes, you're right, but then it will be a gradual journey. And this year, ULIPs will continue to do well, given how markets are.
Manas, let's come to what you like in this space. And I'll come to non-life and then to life. You are saying HDFC AMC is outperformed. Nippon is as market performed. And you're preferring HDFC AMC to Nippon. Why is that?
Sure. So the only reason behind that is the level of cyclicality in the business that I'm seeing. The way I am thinking about it, these stocks and the broader India market is not cheap at this point. We can debate whether it's costly or it's fair price. And my view is it's more towards the costlier side. So because asset management industry itself is cyclical, because mark to market forms a very big part of their AUM movement. And then within that, HDFC AMC, lower exposure to mid-cap, small-cap, multi-cap funds, higher exposure to hybrid funds. So if and when markets turn, Nippon will probably see a sharper downturn in stock prices than HDFC AMC. So that's the only reason. Both companies have fantastic performance tailwinds. Both are gaining market share. They both benefit from industry tailwinds in terms of SIP flows continuing to be strong. So it's only a valuation or a risk call. From a fundamental perspective, both businesses are doing very well.
Also, Manas, your note talks about how, distributors also stand to gain significantly, and maybe there are no biases there, no loyalties. They can sell whatever sells, really, right? But your recommendations don't feature any distributors except PB Fintech, which I'll talk about in a minute. But anything else on the distribution platform that you like, any wealth advisory firms that you like? Because the likes of an Angel One and Nuvama and Edelweiss, 360, while they manufacture products, they also have a pretty active distribution arm.
Correct. So that's exactly the reason they don't feature in the set, is because I don't cover the names actively. From a value chain perspective, if you see, what works for them is they get a percentage of AUM as their revenue, similar to asset managers. And as you rightly pointed out, they diversify their client holdings across various fund houses and various asset classes. So even if a particular asset class or a particular fund manager does not deliver returns, it is possible that the client portfolio returns are not that bad. So performance risk that is attached to an asset management stock is lower for the distributor for that reason. And revenue model or growth is similar. So that's the point that I'm trying to make in my report, that if you have a positive view on the mutual fund industry, they may be a good way to express that positive view. I don't cover those names, and therefore you don't see that in my preference list.
Fair assumption is, Manas, over the next couple of months, you may add coverage to those stocks as well, because you can't not cover them, especially
position
because
to-
you're constructive on the distribution space. Also, very quickly in the insurance pack, I realize that you don't have any biases, right? Private insurer players, public insurer players, life versus non-life. You want to quickly just take me through that? And also, these stocks have already ran up significantly. How much more upside from here is the question, and what is the time horizon we're looking at?
Sure. So just to confirm, I cover only life insurance. I don't cover general insurance at this point in time. And then the preference within life insurance is towards private life insurers who have a good distribution franchise in terms of their parent bank support. So the top pick is SBI Life. I also like HDFC Life and Max Financials. In terms of these stocks running up in the few months and weeks, yes, they have. But then if you take a longer term view, they've been laggards because of regulatory issues, which have plagued the industry over the last 2-3 years. I think there is valuation support, and I think regulatory issues, at least known issues, are behind us, largely priced in. So there is upside in my mind on the life insurers. That's how I'm thinking about it. I don't cover general insurance, so won't comment on that.
And LIC, lion's share still of the market, lagging behind and losing that share consistently. But even so, as a business, you're not too constructive on LIC?
Sure. So I think since listing, the management has become far more active in terms of product launches, trying to change the product mix and improve the margin profile. They've seen good performance on the back of that as well. It's now at that point where I think all the efforts will not necessarily change the growth trajectory. I see margin upside from product mix, but then they are also going to face product level margin pressures, and they are now trading at 1x embedded value. So defining further upsides, I think I would like to see more conviction in my mind on improvement in product level margins. And the other is how do you change the growth trajectory? Those are 2 points where I'm not as convinced, and therefore a market perform after the run up that we've seen in the stock.
One platform, one distribution that you cover is PB Fintech, who again had a good dream. It's had a dream run, right? You can't be complaining. Where from here on PB Fintech?
Sure. So I think on a business model basis, I like distribution in the insurance construct more than the manufacturers or insurers. I think distributors extract more commissions. All of it is upfront, so very little operational risk. Fantastic business model, exposed to high growth segments in online, high growth segments in pull products or like term and health. So the growth story has been fantastic. I think they are going to deliver very strong growth on the business volumes of GMV. That will translate to revenue as well. Economics on the margin side are improving. So taking a positive view on the business model, run up a fair bit. It's close to my target price now. So I think Q2, Q3, they'll deliver higher growth than what people and me are penciling in. So probably near-term upside, but then valuations are stretched. So difficult to really wrap your head around long-term, medium-term upside. Long-term, I think the business will make money, but you'll need to be patient around that.
All right. Thank you so much, Manas Agarwal. They're talking about the capital markets play as well as the insurance play right now. Manas, great to speak with you, and thank you for all your insights. Meanwhile, quick look at what's happening in the markets right now, and fairly steady on the Nifty as well, above the 25,200 levels. Well enough, really, not bad at all for a Friday kind of a close. Reality has seen a bit of a bounce back after quite a few sessions, so that's one story that's definitely buzzing. The Bank Nifty is also, in a sense, not a huge bump up, but Bank Nifty and banks is definitely the story of the day. Nifty PSU Bank Index also above 1%. Pharma stocks also running fairly decently. Let's just pull up the heat map for a second, see what's happening there, at least on the Nifty, and what the market breadth also looks like at this point in terms of stocks. You're seeing a fairly decent run up over there, more greens than reds right now in the market. Sugar companies also one that we should look at very, very clearly, and sugar really is the theme of the morning, theme of the day. Let's see what's happening with some of those stocks. Balrampur Chini, Sri Renuka, all of them buzzing in trade. All right, before we wrap up on the show this morning, here is a sneak peek into our exclusive conversation with Raymond's Gautam Singhania.
Maybe mine is a contrarian view, but I see South Bombay primarily because of the amazing infrastructure that is coming up. Because today, if, say, for example, Breach Candy is on like 50,000 rupees and our Bandra project is 35,000 rupees, and by the Sea-Link coastal road, you're there in 10 minutes. And so at some place, water will find its own level. So a lot of people are still very bullish that South Bombay will become 1.5–2 lakh rupees square foot. I'm a little skeptical on that. So there's just, there are two different views. Nobody knows whether
you think the prices will fall in South Bombay?
I believe they will fall. That's my view. But that's purely my view.
welcome you watching Talking Point. Andrew Holland, CEO of Avendus Capital Public Markets Alternate Strategies, joins in to talk to us about his word on the markets. Morning, Andrew. Thanks for joining in. Pleasure to talk to you this Friday morning. First up, the last 12 days, the markets have shown resilience. They've been gradually climbing walls of worries and making new highs. While there may not be too many triggers locally, the big cue that everyone worldwide is watching out for or waiting is the Fed rate cut on the 18th of September. Do you feel like this is going to be one where we've bought the news, bought the rumor, and may potentially look to selling the news as soon as it hits the markets?
I mean, that's what I would usually be thinking, Samina, and good morning and thank you for the opportunity. But, it really depends on what Chairman Powell of the Federal Reserve says. Quickly, if it's 25, I think the market's already expecting that, but it's really what the words are about going forward. Because the market's baking in, 100 basis points for the year, December, by the end of December. So that's quite a large move from here. So if it does 50, I think the market has further legs to go. If it does 25, then it really depends on the words that he uses to say how quickly he might move for the rest of the year. And I think that would be the key. So if it remains dovish that we're on this path downwards in interest rates, I think the market would like that. I think the fear for the market has always been is that the Federal Reserve did get the kind of the move on the upside delayed. They thought inflation was transitory. So I think the market's expecting now then to be ahead of the curve. And I think anything that's not seen to be like that would cause some more jitters in the markets. But before that, before the 18th, we have some jobs reports next week. And I think that will give us a flavour of how much that rate decrease might be. Is it 25 or 50?
Andrew, okay, now let's move focus back to largely what's happening locally as opposed to the global triggers. One case, of course, is that the possibility of a deep correction may be ruled out at this stage given the amount of consistent domestic inflows. Would you agree with me?
Yeah, we've become like a low beta market, really, with all the cash that's sitting it's coming into the markets and sitting in the sidelines in some of the mutual funds where I think cash levels are reasonably high. So we're all kind of sitting there kind of thinking, valuations are high, we need to see a correction. But you're right, with this weight of money, it's not happening. So unless we have a sustained fall, where people feel some pain, it's really not going to, kind of stop these flows for the time being. So, but you're really kind of looking around to find where there's value, and it's very difficult to find at the moment. So that's why the market, yes, it's creeping up and it's hitting new highs, but I think most of the gains for the year. And we're looking at, say, 15% earnings growth, and we think the market should rise in line with that. You're already kind of clocked in around 12, since April the 1st. So I don't think there's that much more to go in the very short term. So I still think the risk is to the downside, but it doesn't necessarily mean it has to be a big downside. So if markets globally correct 5-10%, we'd probably correct half of that.
Where do you see value among sectors? I do understand that the broader market valuation may remain stretched, but where is it that you find value, and which are the sectors that cannot be missed in one's portfolio?
So it's a kind of ongoing equation in terms of finding the value. I'm just not finding it. So what I'm doing is continuing to look at. We talked about this before, Samina. Is the themes that I think will play out over the longer term, where I'm happy to pay higher valuations on the broad theme. So we talked about these before, but defense spending, renewable spending, and obviously the themes that I think will continue to play will be hospitality. I think people will continue to travel and enjoy experiences. So hotels falls into that. Premiumization in the beverage sector, both alcoholic and non-alcoholic beverages, and the electronic manufacturing sector, which again is a long runway. We're just at the start of it. So these are the kind of companies and sectors which I think are long-term themes that are not going to go away from us. But the catalyst, I think, for the market to move higher, Samina, is when is the bank sector going to move higher? And I think it's been something that we've been talking about, we get excited about. But it's not really happening. And I think it can only happen once interest rates start to fall in India. and you get those obviously those gains from the bond holdings, which will help the banks, and obviously that would trigger we hope the private capex cycle more, and therefore lending to these corporates. So corporate borrowings and lending will start to increase for the banks and get us a lot higher ratios going forward. So that's where the problem is the banks is not participating really. So maybe with interest rate cuts, that's the catalyst.
Fair point, you're right. We've all been waiting for the banks trade, the private banks especially, the trade to play out. But, while you indicated that we might see this once rates come off, that is at least 6 months away. And that's the regulator's been very clear about, reiterating that time and again, that we're still not ready to lower rates even if the Fed does so. In a case such as that, maybe now may not be a good time to buy banks. There would be an opportune moment between now and December to do so. Or would you start lapping up banking stocks now already, if you haven't?
Yeah. So if you're working on the basis, then, Samina, I take it you're taking that October